Good morning, and thanks for joining us today. I'm Chris Brightman, Chief Investment Officer at Research Affiliates and Co-Portfolio Manager with my partner Rob of the PIMCO All Asset Strategies. Today's webinar, Capital Market Expectations for the Next Decade, will be presented by our partners, Brandon Coons, our multi-asset strategist, and Jim Masturzo, who leads our asset allocation team. Before we begin, I bring your attention to two articles we've recently published, both of which set the stage for what we expect during the coming decade of the 2020s. First, reports of value's death may be greatly exaggerated. Here we study in detail the dramatic underperformance of value over the past decade. We demonstrate that the primary driver was growth stocks getting more expensive relative to value stocks, a process we call revaluation. This revaluation accounts for 70% of growth's outperformance over the past decade. Looking forward, with today's valuation gap at an extreme, the 97th percentile in history, the stage is set for historic outperformance of value relative to growth. Second, forecasts or nowcasts, the outlook for the 2020s. Here we point out that many so-called forecasts merely explain what's happening now, implying that extrapolating recent trends is an insightful long-term forecast. In contrast, we create our 10-year forecasts by assembling the fundamental building blocks of future returns given today's starting prices and yields. You may access both publications on our website or via the resources widget at the bottom of your screen. Over 5 years ago, we launched our web-based asset class forecasting tool, Asset Allocation Interactive. We provide this tool to help you create investment plans using forward-looking return expectations conditional on today's market environment. We provide monthly updates to our forecasts for over 130 asset classes, and the site is viewed by over 100,000 unique visitors per year. We hope you find our website and this webinar helpful. Following Brandon and Jim's prepared remarks, please reach out to us with your questions using the Q&A widget at the bottom of your screen. Brandon, over to you.
Thanks, Chris, and thanks everyone for joining us today. As to the agenda, I'm going to take the lead on walking through historical asset class returns and then take a moment to decompose those returns into their constituent drivers. And then I'll pass it to Jim to speak to our return forecasts and walking through our asset allocation interactive tool on our website. I'll also point out that while Jim does that, I may chime in to ask him questions about some of the functionality and return forecasts that we provide that we often get questioned about in the field. With that in mind, let me now look at the last decade of historical returns. On this slide, what you'll notice is that the best returning asset class, and these are nominal annualized returns over the last decade, was U.S. large cap equities. You look at the very bottom of the chart and you'll notice that the worst performing exposure was commodities at minus 4.7% annualized. Scrolling back to the top half of the slide, what you'll notice is that the vast majority of the best performing asset classes have the initials US in them. In other words, this was a phenomenal decade for any US-based exposure, and any diversifying and or international exposure tended to offer returns in the 5% range or lower. If you look to the upper left-hand side of this particular chart, you'll see that a 60-40 portfolio in the US delivered nominal returns of 10.5% per annum. So the question now becomes, where do these returns sit as it relates to the returns of a full sample experience? And on page 6, what we do is we look at equity, 60-40, bond, and cash returns, and we look at that both through a nominal and a real return lens. On the left-hand side of the slide, you'll see nominal returns. We'll show you inflation in the middle, And then on the far right, you see what the real returns are for each of those arenas. Equities coming in at 9.1% per annum. On the far left, a 60-40 portfolio in the mid-single digits of 7.7 nominal, and bonds coming in at 5%. Now, the 60-40 portfolio at 7.7% over a full 150-year history is certainly lower than the 10.5% returns that we saw in the last decade. And if you look at the far right, particularly the 60-40 column, you'll notice that the average real returns, so returns net of inflation for a 60-40 portfolio, are actually closer to just over 5%, 5.6. Now, what if we look at this on a decade-by-decade basis? If we go to page 7, what we've done is we've taken this same information and we've broken it out by decade, starting in 1871. I'll point out that the first decade is only 9 years, but then all of these other subsequent decades are full 10-year experiences. And you'll see the realized equity return by decade on the left column still averages what we showed you on the prior slide, but you can see how it is broken out on a decade-by-decade basis for each of the last 15 decades. 2010 through 2019, returns of 13.5%, but the decade before, the realized nominal equity returns were negative. You go to bond return column and you'll notice that the last decade was 4.8. Where did this sit in history? Well, on the equity side of things, this is the sixth best return, this is the fifth best return environment for equities over the last 15 decades. And for bonds, you get more of a middle of the pack experience where the returns are just below the long-term average of 5%. Now, when you scroll all the way to the right and you see the realized returns for a 60-40 portfolio, what you'll notice is that most of the time, 60-40 delivers a single-digit experience. There are, however, a few instances where you get better than that in terms of annualized returns, and most of those actually happen over 3 of the last 4 decades. It makes me wonder if our expectations for asset class returns are artificially higher based upon the predominant experience that most investors have gone through in our lifetimes. So these are the returns by decade. What about just the decomposition of these different returns into their constituent drivers? We also break this out and we show it for equities on page 8. If you look at page 8, what you'll notice is that we break it out into their different building blocks. At the high level, you can think of these building blocks as yield, growth, and valuation, and I know Jim will get into this. But really, the total return of equities is largely comprised of the starting dividend yield on the far left. From there, we look at real earnings growth, and you can see that that has been, over a full sample environment, 1.9% per year. And then if you add inflation to that, you get an additional 2.1% return. And then from there, we add in some valuation changes that are reflective of valuation expansion that has happened subtly over the last 150 years. All in, that gets you to a realized equity return of 9.1%. Now, we'll get to this, but today's starting dividend yields are much lower, so one should expect significantly lower real returns moving forward. What if we go to the next slide, though, page 9, and we break it out again by historical bond returns, but look at those constituent parts. Once again, the real yield average for historical bond exposure is 2.3%. Inflation once again coming in at 2.1, and then valuation change being positive, again reflective of bond prices increasing slowly over the last 150 or so years. That brings you to a realized return of 5, and once again you can look at the starting real yields of bonds today and recognize that that column on the right in the future may not be as high. So with that as backdrop, as it relates to the historical returns that we've experienced, not only over the last decade, but on a since inception basis, let me turn it to Jim to dive a little bit deeper into our return forecasting methodologies and our current return forecasts available on Asset Allocation Interactive.
Thanks, Brandon, for the retrospective. So let's turn our attention not from what has happened, but to instead what we think will happen going forward. And to kick this off, slide 10 here looks at three different approaches or methodologies for forecasting expected returns. This is not, there are other methods out there, but these are the three that we find to be the most commonly used. So model one is the simplest model, which is the past is the future. So extrapolate historical returns and assume those are your expectations for the next decade. So essentially, from the previous chart that we showed on decade by decade returns, just take those the last decade's returns and assume that those will last into the future. And this is basically the thesis or the issues with this are the thesis found in the article on nowcasting that Chris referenced at the beginning of this webinar. There's a number of issues with this. Most specifically, it doesn't account for things like mean reversion or just current status of the market. It just assumes that things always stay the same. The second model, the constant Sharpe ratio model, is the way of saying assume every asset going forward has the same Sharpe ratio. Another way of saying that is it's easy or easier to figure out the volatility of assets over a long period. And based on that information, you can, and some estimate for what Sharpe ratio you think assets will deliver. Maybe that's 0.3, maybe that's 0.25, give or take, whatever. You can infer an expected return. And this is a nice way of saying you don't have any information on returns, so you're just going to use the Sharpe ratio approach. This can work well over many, many decades. Depending on your setup and risk tolerance and things like that, an equal weight portfolio will also fall out of this. But it also throws away any information that you do have about the present. And that takes us to model 3, which is the building blocks approach. And this is the approach that we actually use, where we say, let's take volatility information that we can forecast and actually add in some information that we know based on how the market is set up today. And before, so let's take the building blocks approach and let's actually just use a simple proof statement to talk about how it does. So this model here is a simplified model. It's not actually the model we use, but by talking about this very simple model, it'll make it easier to understand as we go forward in this webinar. So this model is looking at expected returns for both equities and bonds, and then the 60/40 portfolio compared to the realization of what the returns were for that 60/40 portfolio. So we start in the upper left with the beginning dividend yield. The most basic and the starting point for most asset valuation models for equities is the dividend yield, which you can read from your Bloomberg terminal or Yahoo Finance or wherever you get your financial information. So we can look that up. And to that we have to add a real earnings per share growth. So dividend yield plus earnings per share growth is essentially the Gordon growth model that most people are aware of. And here we look at a simple metric, which is just long-term trailing 40-year average real earnings per share growth. So you can see that that number has been coming down over the last few decades into the 1% range, a little bit larger today. But has been coming down at least in the most recent decades. And again, that's not a value that we actually use, but for the purpose of this simple illustration, is a nice number to use. Implied inflation just looks at the difference historically at the start of each of these decades between nominal and real bond yields. And so if we add up those three components, the dividend yield, the earnings per share growth, and the inflation, we get a nominal expected equity return, which on average has been 7.7% over the 150-year period here, or 4% in the 2010 to 2019 range. And to that, we just use the most simplest model for expected bond returns, which is the starting yield. If you look at the starting yield and look at decade by decade returns, you see a very high correlation between between those values, and that just stands to reason from sort of standard finance theory. So, the moral of the story here is if we look at the 60/40 portfolio and we compare our expected return to the realized return, and the far right column shows the difference, the number is never, is never perfect. Our expectations are not, nor do we expect them to be exactly what the realized return is going to be. However, they should be close, and that's what we see. And if you just look at the colors and ignore the numbers, what you see is a number of green numbers followed by a number of red numbers. So the green numbers is when our expectation was above the realized, and the red number is when we were below. So you see this kind of back and forth action. So in the 2010 to 2019 period, we actually underestimated the 60/40 portfolio. And if history is a guide, then we would expect that our estimates may actually or overestimate going forward. But on average, over this 150-year period, the difference between our expectations, or the expectations of this simple model, and the realized is 1.2%. So, pretty close. As I mentioned, that's not what we do. That's just a nice simple proof statement. Slide 12 shows something, or shows the graphic of what we actually show within our interactive site. So although there's a lot going on here, if you focus your eyes in the middle of the screen, kind of on the left, you'll see the same types of things that I've been talking about and that Brandon talked about earlier, the dividend yield and earnings growth. So dividend yield, again, starting dividend yield, you can look that up. If you're valuing the S&P 500, you can look up the index yield. On the current index yield, 1.8, 1.9%. And to that, you add earnings growth. On the previous slide, I showed an example of trailing 40-year earnings growth. What we actually do is look at something that's a little more time varying and a little more recent information by actually focusing on and estimating retained earnings. So retained earnings being the engine for growth for companies, we actually take that number and actually build it up to come up with an expectation for earnings growth. There's also a box here called rebalancing drag. And essentially the easiest way to think about that is in the context of a large cap index like the S&P, where at the bottom of that index, call it companies 490 to 500, give or take. Companies that are doing poorly, their market caps will fall. They'll fall out of the index, and they'll fall out of the index as their prices have been falling and be replaced by companies whose market cap is rising to get into the index. And then if you believe in mean reversion, you'll see this churn. And empirically, we do see this, where those companies that fall out will eventually go back in, and vice versa. So you get a little bit of a drag on the index return. And then the valuation change. Brandon noted earlier, historically, the valuation change, which is nothing more than multiple expansion or contraction, has been relatively small compared to the overall return of the index. So it's about less than 1% of the 9% historical return. And what we look at here is we use the cyclically adjusted price to earnings ratio, the CAPE ratio, and compare the current value to a fair value CAPE. And that fair value CAPE is a globally generated number that we come up with. Now I should note all of the information here, and there's a lot here to digest. At the bottom of this page, and we'll point this out when we get to our interactive site, there is a page for resources that actually contains links to a number of methodology documents, one per asset class. And those are short summary documents that actually lay out with how we derive our expectations for each of these building blocks.
So one question here, Jim, and that is that, oftentimes when in the field we get people talking to us about these long-term return forecasts, and they say something to the tune of, hey, we know you guys run your own multi-asset portfolios. Is this the exact forecast that you're throwing into your optimizer in terms of, your own tactical multi-asset portfolios?
Sure, it's a great question. I also get it quite often in talking to clients. And the answer is, this is not the full story when we talk about actually managing the multi-asset portfolios that we manage. This is part of it. So thinking about the long term, thinking about strategic allocations is an important part of the process. And we do use this structure here for that. However, coupled with that are short-term, tactical, dynamic signals and dynamic components that take into account the fact that things like the business cycle are changing, market dynamics are changing, they're changing for different asset classes in different ways. Using this information here on slide 12 alone basically implies you're going to do something like a buy and hold for the next decade or so, which most investors either can't or are unwilling to do.
Got it.
So let's, with that, let's flip over and actually go to the interactive site and look at what our expectations are today. We know that many investors are at the beginning of the year reassessing their capital market expectations and their policy portfolios and those sorts of things. So makes sense to look at what our allocations are, our expectations are today. To start, let's just look at the U.S. large cap. Let's look at the S&P. And again, Brandon looked at this historically, and we talked about the methodology going forward. But here we can see that our expected return in nominal terms, again with inflation, for U.S. large cap stocks is 2.4%. You can see that number right here. And what we do on our site here is we actually not only show you the total, but we break that down into the building blocks that we've been discussing throughout this webinar, and we can see that it's 1.8% comes from the dividend yield, 3.4% is capital growth. This again is nominal earnings per share growth, so both the real component plus inflation, and 2.8% or negative 2.8%, so a valuation headwind from reversion in multiples. For anyone familiar with the CAPE ratio, you'll know that the current value in the low 30s is far above its long-term average, which is in the mid-teens, and even the fair value that we look at, which is in the 20s. And so in thinking about the next decade and expecting reversion there, we forecast a 2.8% headwind, getting us down to our 2.4% expected return.
So just looking at the vertical line here, Jim, through the red dot, which essentially shows us our U.S. large cap forecast, what does that vertical line mean?
Yeah, so it's really important to think about this line here is what Brandon is referring to, that goes from 6.2% to minus 1.4%. Essentially, when we talk about expected returns, many times we talk about the median, or the mean of the distribution for an expected return, and oftentimes it stops at that. But what we're really talking about with any of these expectations is a distribution. And here we're showing that we have 90% confidence, so let's call it 5% to 95%, that middle 90%, that the expected return for U.S. large will be somewhere between minus 1.4% and 6.2%, with the mean being the 2.4% that we talked about before. And in building portfolios, it's important to capture all of this information, to not just focus exclusively on the mean, but to actually use a Monte Carlo or resampling type process to incorporate all of this information.
Got it.
So that's stocks. For completeness, why don't we look at bonds? And I'm going to go over here and click on the U.S. aggregate, which is the most common fixed income index for investors. And the Barclays U.S. aggregate, we can see that our nominal expected return, again on the right, is 2%, 2.6% from the yield, and 60 basis point valuation drag from our expectation of yields moving from their current position of about 1.8% up to closer to 2.9 or 3% over the next decade, giving a 60 basis point headwind to bonds. So earlier in our simplified example, we just looked at the dividend yield. Here we're actually putting in a component for reversion in yields. If we step back for a moment, and I just click out here, so just focusing on this scatter plot of returns. And what I'm going to do is actually hide a few things here just for a moment, just to clean it up a little bit, just so we can focus exclusively on asset classes. What do we see? And this is an important thing for investors as we think about the 2020s. Well, by and large, most of the dots here, forget about the names and all of that, are lower than 4% nominal. There's only a few asset classes that are above 4, and only technically 3 that are above 6%. That being the EFA or developed market equities, emerging market equities, the top red dot, and then that purple dot in the upper right is actually developed market private equity, which for the purpose of this webinar we won't spend a lot of time on, since many investors don't have access to that to that asset class.
So Jim, can you add back in the model portfolios? I was looking at the 60-40 there, and I just, a quick notice is that the 60-40 portfolio seems to be higher when you back out of the screen than the S&P 500 dot and the BarCap Ag dot. It seems like it's not like an exact 60-40 mix of the two. So what drives that?
Yeah, that's right. And the reason for that, we can see the nominal expected return here for 60-40 is 2.4%. And I went ahead and expanded it to address your question. Essentially, the way to think about this is that these individual components are the simple weighted averages of those numbers. However, because we're showing geometric returns and not arithmetic returns, which are more common for most investors, it's what we think about as our return over time. When we aggregate those together, we get what's called a diversification return, or you can just call it a compounding return, or whatever we choose to call it, diversification here. And so that's an extra 10 basis points, which is why those numbers aren't exact weighted averages of each other.
Got it. So obviously investors don't hold a 60-40 portfolio. The return expectations look particularly low in nominal space. What about something that may be more indicative of what they actually own? Do we model kind of maybe their portfolios for them, or the average portfolio for them?
Yeah, so we have what's called here a little bit above the 60-40 portfolios, what we call this advisor average. And let me go ahead and click on that. And the advisor average, we can see the expected return is 3.4%. The volatility is about 10, which is in line with what many advisors have, at least from a volatility perspective. And what we've done here is actually aggregate across many different providers the model portfolios that different advisor shops are using to come up with this quote-unquote advisor average. And we can see that it's 51% equities, about 26% core bonds, 5% credit, so on and so forth. The breadth of advisors that we use actually includes even some allocations to hedge funds or private equity. And if we expand one of these, and I'll just expand equities for a moment, you can see that of the 51% in equities, 35% is in the S&P 500 or a similar U.S. large cap, index type strategy.
Okay. So do we have anything for institutional investors as well?
We do. We have another portfolio over here, which I can click on, called the public pension portfolio. Oh, excuse me, I have it hidden. Let me unhide it. The eyeballs here being gray means that portfolio was hidden. And again, we see similar type return, 3.6%, expected return, and the allocations are below.
So I'm looking at this upper right portion, and it says something to the tune of probability of 5% real return. It's less than 1 there. What's going on?
Yeah, so since we're talking about a probability of 5% real return, let me go ahead and change the returns, or our expected returns, from nominal to real. And I can do that under settings, and it's very easy to just toggle from nominal to real. Just while I'm here, I can also note that for any of our listeners who may be outside the U.S. or interested in non-U.S. dollar expectations, we also offer everything you see on the site in these 5 different currencies. But let's stick with U.S. dollars for now, and let's go back to our details. So essentially, when I go back to the details, and we're on this public pension portfolio, we've netted out inflation, and we can see our expected return is now 1.5%. Now, knowing that many investors have a 5% real or 5% net of inflation bogey or return target, we've actually laid out what we think the probability of actually achieving that 5% target is given this portfolio. And you can see here it's actually less than 1%. If I scroll down, and this is similar to the information on the confidence interval that we looked at before, we can see that we have this green chart here, which is showing that given our models, this portfolio has a 95% confidence of having a return greater than a negative 70 basis points, 75% probability of greater than 50% or 50 basis points, and so on and so forth, up to the 5% probability of greater than a 3.6, and then the less than 1% above 5%.
And the odds at the top of the public pension portfolio are still less than 1%, correct?
That's right.
Okay, so I'm noticing the efficient frontier portfolios that are kind of like shaded out in the middle there, but what do the odds jump to of those efficient frontier portfolios in the middle of the screen of achieving 5% real?
Yeah, so this public pension is about 8.5% volatility. The advisor average we looked at earlier was 9.9. So I'm going to choose the 10% volatility portfolio from the efficient frontier. And here we can see that the probability of 5% real return is still only 20%. So, going back to what I said earlier with, expectations for many asset classes definitely being below 4%, many below 2%, and some even negative, trying to combine these assets, even using an optimizer and a relatively unconstrained optimizer to calculate a portfolio of max return, it still only gives you a probability closer to 20%.
So is there a way that investors can look on this and say, all right, I can see the efficient frontier portfolio, I can see the advisor average or the public pension portfolio, can I compare the two to see what deviations I may make to my own asset allocation?
Yeah, exactly, and that's this drop down here. So let's go ahead and, since we're already on the 10% volatility, let's compare it to the advisor average. And again, you can compare it to any portfolio. You can even compare it to portfolios that if you create your own portfolios, you can do those comparisons. So what we see here is the comparison of expected return and volatility, as well as the comparison of the allocations. And this is what gets interesting. So if I go ahead and again expand equities, what we see and what we noted earlier is that the average advisor portfolio is 35% in U.S. large cap stocks. Our efficient portfolio, and again given extremely low expectations for returns of U.S. large cap stocks, has zero allocation and is much more global diversified with 8% in developed markets, but a whopping 22% in emerging markets. Now, this doesn't mean that investors should run out and all of a sudden, change their portfolio over and sell 35% U.S. to buy 22% emerging. What it does mean is you need to start thinking about other assets that you might be have not thought about in the past, or may even be somewhat still uncomfortable, and start learning about those assets and start to move and become a little more diversified from where this starting is, at least this average starting portfolio.
So just looking at the clock here, Jim, we're running out of time, and just wanted to maybe stick with that theme that you just started on, and that is, what can investors do in today's environment for maybe the next decade or the next few years to help better achieve their return objectives?
Yeah, it's a great question, and it's really the reason we're doing this webinar. And you can think about it, or investors can think about a couple of things. One, just from this scatter plot right here, it basically implies that passive investing isn't going to cut it, especially if you have a 5% real return target. It's going to be really hard to get there with simple passive investing alone. You have to widen. So the first thing to do is to widen the assets that you consider, as we just showed. Things like emerging market equities, developed market equities, emerging market cash and bonds. Even commodities and REITs a little bit for diversification, but start widening that net, as well as explore opportunities within asset classes. So there's low-cost active and smart beta options to add alpha on top of these estimates. Again, these are all passive indices. There's no alpha. You can think about other alternative asset classes, global macro type things, systematic alternative risk premia and other sorts of risk premia. Those types of strategies should be on the plate for advisors to at least start learning about, if not, putting their money on the table.
Got it. So we're running out of time, so I'm just gonna cut us off here and ask that the audience submit any questions if they haven't already for us that we can look to answer here. And while our marketing team is compiling these questions and kind of generating different themes, I'm going to start us off with a question that I get a lot in the field, and that is, if you're looking at this tool for the first time and you kind of want to work your way up the learning curve and you don't know what the functionality is, what outside of what you've already showed us today is something that's maybe highly interesting or something that investors should explore on AAI?
It's a great question, and I'm going to answer it in two ways. One is, what's the when you first come to the tool, what's the first thing to do, or the easiest thing to do for anyone who's new. And then I'll also show a somewhat more advanced feature for any of our listeners who may have already be using the tool. So for someone new to the tool, there are a lot of different charts and analytics baked within this. The first thing I would click on is this link here called Charts. And essentially this lists every chart that is available within the Asset Allocation Interactive. So we have our expected returns, historical returns, correlation matrices, CAPE ratios. If you want to see not just current yield curves, but our forecast for yield curves, we have links for those. And this list goes on, and I'll let our listeners, explore in their own time. The other feature, which is kind of interesting, especially for anyone who's maybe doing country by country investing, so not necessarily investing in, say, developed market equities, but thinking about, France or Germany or what have you, we have what's known as, I'm going to change this link here from portfolio mode to what we call full asset mode. And you can see there's a whole lot of dots that appear now. There's about 130 dots. And if I open up our equities, you can see that we actually now list or include expectations for each one of these countries individually. And just like we did with the other assets, you can drill in and learn all about how we model those.
Got it. So looking at some themes here on the questions that have been submitted, there's a few of the similarly themed questions that essentially boil down to how accurate are your return forecasts? Here's another one that says, since you launched the tool 5 years ago, what's been your track record? Basically, it's just historical accuracy questions about the return forecasts.
Sure, and I'll beg forgiveness from our viewers. I'm going to flip back to the slides here because we keep a slide around because this question comes up a lot in our conversations. And this slide comes from something that I wrote a few years ago. It was an article called Simple is Not Simplistic. And essentially what we did here is look at, on the x-axis, there are these buckets. You can see -2% to 0, 0 to 2, so on and so forth. And what we did is take all of our forecasts across all asset classes and break them up into, for each period, and break them up into these buckets. And then for each of those asset classes in those periods, we measured the subsequent 10-year realized return. And what we can see is that in the first couple of, call them columns, so, -2 to 0, 0 to 2, 2 to 4, we're right in line. So we're basically in line with our expectations. So for instance, or excuse me, actually, I apologize. For those three, we're actually a little bit, we were a little bit, bearish. So the -2 to 0% expectation, average returns in those periods was about 1.2%. Same thing for the 0 to 2 and 2 to 4. But when you get to the 4 to 6 all the way up to the 12 to 14, and again, this is actually where most expectations historically have fallen, you can see that our expectations, or our range, fits right in line or is very similar to the mean, which is the diamond in each block. So when our expectations are between 4 and 6%, the average return was 5.9. 6 to 8% expectation, 7.4%, mean return.
Now, it looks like there's a labeling issue here. Series 1 being the resulting 10-year returns, Series 2 being what the high end of that range, and then Series 3 being the min. Is that correct?
Yes, that's absolutely right. The diamond is the blue diamond. Series 1 is the median, and then the max and min bracketing that.
Got it. So looking at another question, this is a bit of a customization question, which is interesting. It says, if I want to create portfolios in this tool with different asset class forecasts, is that possible?
Right. So that's another great question. And again, I apologize, but we will flip back to AI. And let me show a different tool. And we'll go back to our simpler version where we only show some of the asset classes. And one of the pushbacks we get all the time has to do with valuation change. And so, as I mentioned early on, U.S. large, the CAPE ratio reversion is about a 2.8% headwind to U.S. large. Now, some investors say, great, I like your models, but I don't believe in that, or I want to downweight that somewhat. What you can do is actually turn that off. So we have a number of different expected return models. So you can't create your own expected return model, but you can use these two different models, valuation dependent, that's what we've been looking at, or yield and growth, which essentially just sets that valuation change to 0. Or if you say, I want some valuation change but not all, you can actually create a model and blend these two together. In this case, it would be a 50-50 split, or you can make it 80-20, whatever you want to do.
Got it. Here's a question, well, a couple of questions here. I'll just read them both. They look like they're similar in theme as well. Do you provide return forecasts for value and growth indices by region as well? And then there's another one that says, do you provide return forecasts for equity factors?
The answer to both of those is yes. I don't think we'll have time to go through this, but essentially from our Asset Allocation Interactive, we have this hamburger chart here and a link to what we call Smart Beta. And this takes us to our Smart Beta Interactive, which does exactly that. It calculates expected returns for different strategies, value, growth, income, quality, so on and so forth, or different factors. Again, similar names, but now looking at it through a specific factor lens as opposed to market strategies.
Well, thanks, Jim. Look, we're out of time. We, I guess we kind of got into this and ended up going a little bit longer than we thought we would, but we're going to have to wrap up here, and just wanted to reiterate our thank you to everybody that tuned in today. Hopefully you found this webinar helpful in understanding the functionality of this tool, understanding our forecasts, and maybe this has given you some ideas on a forward-looking basis to think about how to better navigate today's investment landscape. Also, I'll mention that if you have a question that you've submitted, and admittedly we didn't get to a lot of them, we'll be looking at all of those questions and seeking to reach out to each of you individually to respond to those. So be on the lookout for an email engagement from our other relationship managers. I'll also mention that there's going to be a brief survey after the webinar that's going to pop up, and we'd love it if you could respond and provide us with your feedback. With that, thanks again, and we hope you enjoy the rest of your day.